Are Washington, D.C. home prices absolutely collapsing because Doge is going in, firing any worker they can get their hands on? Here on this chart, you can see an 8.6% decline in real estate prices in Washington, D.C. since, well, I mean, it is a year-over-year comparison, but if you look at what the Kobisi letter says, they say since Doge began its layoffs. Take a look at this. Folks, as a real estate broker and, well, the CEO of a real estate company, what kind of insights can we actually glean from the data to suggest, is this because of Doge? Are real estate values collapsing in the DC area because of the Department of Governmental Efficiency going in, potentially laying off as many workers as they get their hands on, especially with Donald Trump's resignation offer, which 75,000 federal workers have reportedly, according to the Wall Street Journal, accepted. Remember, that resignation offer allows you to, quote, resign from your federal job, where you typically have federal worker protections that don't allow you to get fired once you're past your probationary period. So instead, Donald Trump offered those workers the opportunity to resign, get pay between now through September for doing no work, and meanwhile, you can go find a different job or whatever if you'd like. All you have to do is resign. 75,000 accepted, and now potentially up to 200,000 federal workers on probation have been fired. It's because while you're on probation, you can still get fired. That potentially includes Ariel Kane here. Hey, Elon Musk, your Doge minions just fired me and my colleagues at CMMI. We were working on improving maternal health outcomes at a lower cost so less pregnant women would die each year in this country. I think that's fewer. Anyway, I thought that would fit nicely into your agenda. The admin told the media yesterday that the Health and Human Services cuts were targeted and didn't include scientists or people working on Medicare or Medicaid. Well, I know of scientists who got fired, and I work on Medicaid. Just wanted to point out when you get things wrong like you requested. Of course, there's a big discussion and commentary in here about, oh, well, you know, what organizations were you supporting, or you don't fit into Elon's agenda, and blah, 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 blah. All those debates we don't really have to get involved in right now. What we need to talk about is, are these layoffs in DC leading to a real estate collapse? Well, one thing we know with certainty is that when people lose their jobs, and they need to relocate because they're priced out of an area, yes, the likelihood is that you're going to have to move. However, we're also coming off of the backs of what I like to refer to as the COVID bubble. This is where we had a lot of people relocate from places like California to Texas or Florida. We've actually seen a decline in real estate values in a lot of areas of the country as part of a downward trend. And parts of the country have actually been on an upward trend since COVID. In fact, I've been calling this the COVID reversal, quite frankly, since COVID. If you know, and you've been following me for years, you know that when I started my company, my real estate company, in 2022, we said we're going to buy in the opposite of the COVID reversal markets. So when we started this company, everybody was still flocking to Austin, Texas, and Florida under this impression that, everybody's going there, it's easy to build there. But we know in real estate that when you overbuild in an area and you don't have this continued catalyst to bring people into an area, you end up with an oversupply after accelerated new construction and the prices come down. And that's actually exactly what's happened in many parts of the country. So we preferred to invest in the areas people were quote unquote fleeing from, like California. And what's fascinating is it's worth comparing the DC market and what's going on with quote unquote Doge. Is Doge leading to this real estate price collapse? And what's actually been happening with a broader trend, because this is going to give us an understanding of what's actually happening in the real estate market. So watch this. First of all, this is the Doge chart, where essentially the thesis is, okay, Doge took over and prices started declining since Doge took over. What you really have to know is when you're looking at a real estate chart for sort of pricing fluctuates a lot on a month-over-month basis. And that's because real estate is so diverse. Real estate trades on a median basis. That is, when we look at these charts, we use a median basis, not an average basis. But that median shifts a lot. And the reason it shifts a lot is because you have a different mix of properties. You have condos, co-ops, townhomes, single families, and they trade all over the spectrum. And when you only have about 400 to 500 homes trading in a single month, you don't actually have that much data. So the midpoint, which is what the median measures, not the average, right? That midpoint can actually fluctuate a lot based on if you have, 50 more high-end home sales and for some reason you didn't have a lot of condo sales, that median can move up and down a lot. So I actually think looking at some of the year-over-year data to look at those month comparisons year-over-year is a mistake. You need something a lot smoother than that to really understand what a longer-term trend is. And this is why I bring up the COVID reversal. Now, it's interesting for DC, it's a little harder to piece in there, but let's look at some of the longer-term trends to really see what's going on, and then we'll know what's going on with real estate. All right, here we go. So, on this chart, which is the same one that Kobisi led or compared to, what we can actually do is rather than use these fluctuations, which don't really tell us much about what's going on in the market, we can actually zoom out, not just to the 3-year, but we could zoom out to the 5-year. And if you look at the 5-year and sort of draw a little range around it, you can see we've been bouncing around all over the place. The lower end of the range we have hit once at the beginning of 2020, once now, and once in 2023. And the upper end of the range, we've hit a few times. We hit at the end of 2021, a lot of euphoria there, end of 2022, and then recently in the spring of 2024 here, we've hit the upper end of the range. So this range, you can see, fluctuates by about $120,000. This is an extreme fluctuation in valuation for real estate, given that, median sales price, $560,000. That's like a 20% swing top to bottom. But this is not what we value real estate on, these swings. And again, usually it's just a shift of the median. It's not actually a representation of what's going on with real estate values. To really understand what's going on with real estate value, you have to zoom out more. And so for DC, I would argue that the DC market has actually been relatively flat since COVID. It hasn't significantly benefited from people moving there because of some kind of COVID boom, and it hasn't benefited from a COVID reversal, that is people moving to the higher cost of living areas like California. Now, if I type in something like Tampa, Florida, which was a recipient of the COVID boom, even Kathy Wood ended up moving there. We throw in Tampa, Florida, a recipient of the COVID boom, you can actually see how that COVID boom moved housing valuations in Tampa from a median of about 263 to a consistent pattern of growth to where you actually got from 263 to like the mid 4s there for a while, up to 500,000 in June of 2024. And really only since this peak in the June of 2024 have you really started seeing this slowdown in prices again in Tampa. So Tampa's actually been this a steady grower and beneficiary of the COVID boom, if you will. Let's try Austin, Texas, which is a market that I believe slowed down a little sooner than Tampa. Yeah, look at this, much sooner actually than Tampa. Austin is this blue line here. You can see the blue line actually went from a median of 383, peaked out over here in May of 2022, and it actually declined. Texas declined from there, median of 666,000, oh, the devil's number. Oh, Diablo. 383 to 666. Straight down now to let's get that correct here, 666. Straight down to about 516. 516 from peak represents a decline of about 23%. So Austin's been in this sort of reversal for much, much longer in terms of declines. And you can see DC is mostly flat in this period. Now, what's an area that's basically gone straight up with no sign of a slowdown yet? Well, it's going to be an area where House Hack is heavily invested. San Diego. We're heavily invested in San Diego, but you can really look at various different markets as well. You could look at Ventura County as well. And when you look at California, what's so unique about California is that California, usually people hear Cali and they're like, oh my gosh, fire risk and unaffordability or political risk or whatever. But see, people forget that the reason California real estate is so valuable, and quite frankly, the fires reduce supply, right? That means existing home values probably go up even more. This is why California is outperforming all of these markets. But then again, I've been doing real estate now for 15, 16 years. This is my bread and butter. This is what I'm good at. You can look at my YouTube channel from 8 years ago. All we do is just real estate videos. We knew that this was likely to happen, and it's why we deployed over, 98% of our capital in California markets. We knew that this was likely to happen because of California politics. And this blows people's mind. But when I had a seminar just this summer, I had a seminar in Vegas. We invited Kathy Wood. She was there. A lot of other folks were there. It was quite enjoyable to have a wonderful event, and everybody got to share their opinions and experiences on the market. But one question that came up during our real estate segment was, Kevin, why is it that you would want to buy in California? In California, you have to deal with all the politicians. And my response was, the benefit of all of the politicians and the politics of California real estate is that they're so slow growth and they make it so hard to build that they don't actually realize that the politics themselves in California are actually a tool for keeping property values higher. See, the more the extreme politics of California restrict building and make it hard to build in California, the higher your property values go because jobs are in California. California has the Southern California coastline real estate, some of the best climate in the world. So you got jobs, you got climate. Yeah, you've got some other issues, but ironically, the same politics that people hate on are the reason why home values actually just keep going up in Southern California. The liberal policies themselves make it harder to add supply, and they give you a hedge. So think about this. You buy a home in Texas, and then all of a sudden, everybody else is building homes because there's no delay to building homes. The government's not in your way. The value of your home actually goes down because there are plenty of available substitutes. You don't actually have that in California. Kind of fascinating. So it's something to pay attention to when you're thinking about investing in real estate. First thing that you have to know is we really have to zoom out on the trends. You have to look at a longer term, and ideally you want to get a moving average of the trend here. So Redfin does not allow us to do that here, but if you actually type in Redfin Data Center, you'll be able to. So go Redfin Data Center, and if you grab their housing market data here, you'll be able to get 12 and 4-week moving averages. And this is going to make it a lot easier to understand, is that DC market truly crashing, or is this just sort of like a 3-year flatlining? So we're going to look at DC, and we're going to go to median sales price right here. And here you could see sort of a little bit of a better POV on pricing. So right now, median sales pricing in the DC area, 2025 is the green line. This right here is your year-over-year changes. So look right here at the green line. You'll actually notice that when you look at the year-over-year numbers here on a trend of 4 weeks, home values in DC aren't crashing. They're actually up 2% year-over-year. The same website, Redfin, providing you 2 different sets of data. Why? Well, it's because, look, you had your high sales close in November and your low sales are now closing in December or January. These month-over-month fluctuations are impossible to understand a trend line on. Don't do this in real estate. Real estate is not the stock market. It moves a lot slower. You have to use an average. Go to the 12-week. There you go. On the 12-week moving average, home prices are 3% higher. They're higher than any of these years prior. Now, does that mean that, the layoffs leading to potential sales are wrong? No, not necessarily. I mean, here are unemployment claims in Washington, D.C., you can see they're rising, but they're nowhere near the unemployment claims that we saw in 2022 or during COVID. Those are actually cut off. Probably because if you showed this whole chart, it would be so high that this would look like a joke. This would look like a little fluctuation. Who cares? So this idea that, layoffs are being filed in February of 2025, and therefore home prices are collapsing in DC. Look, that's a popular thing to say. You could get a lot of likes and engagement and tweets and reshares or whatever going, yep, everything's going to crap. Look at that. Real estate's crashing thanks to Elon Musk in Washington, D.C. Look, I've got no real estate in D.C. I don't really care. It doesn't matter. I'm just looking at the data. You can't look at this month-over-month fluctuation because as soon as you turn on the moving average using the same median sales price stat, you actually do not see the data that you're getting on those monthly fluctuations. So sorry, Kobisi. Maybe y'all just don't know real estate or you're looking for some kind of engagement farming, but this is fully false. The facts don't support what you're saying. Now, in fairness, we do have active listings at the same place, but price drops are higher. Not by much. They're higher than the 2024 year, right? So year over year, they're higher. But you only have 0.4% more price drops on the 12-week. Now, if you go to 4-week, this might be a little bit more extreme. Yep, there you go. You're 0.9% over 2023. 0.9% over 2024 and a little bit over 2023 here. So you're getting a little bit of an increase in price drops here, but you generally do at the beginning of the year. I'm not saying that prices aren't going to go down. I'm not trying to take away that hope from folks. I'm just saying when we look at the data, it's too early to say that there's any actual meaningful impact that Doge is having on the real estate market. Now, if you look at months of supply, even months of supply is stable, which this is nice. This is a good tool to look at because it actually accounts for how many buyers you have in an active market. Obviously, there are still people buying. And the number of homes sold so far is actually still exceeding 23 and 24, though well below what you saw in 2022. And then new listings are barely above or out of bound of what you saw in 24 and 3. And this is on the 4-week moving average. You go to the 12-week, it's almost indistinguishable from the prior years in terms of how many new homes you're seeing come on the market or how many homes are selling. Now, look, are interest rates still really high? Yes. Is it unaffordable to buy? Yes. Would it make sense that some people who get laid off have to end up selling their homes and moving? Yes. But that could just unlock inventory for other people who are moving in to buy. So it's too soon to tell. The best way, if you really want to know what's going on with pricing, is get on the ground. Fly to the area. Go to open houses, talk to realtors, understand what's happening on the ground. That is the only way you can know. Sitting behind a computer chair, some kind of desk, I guess you're sitting on a computer chair behind a desk, but anyway, it's not the way to understand the real estate market. So when we at HouseHack were able to time the peak of the Austin real estate market, it was because we were on the ground, not because we're looking at, month over month changes in median sales prices. It's every single month you could have a new headline. Oh my gosh, prices are skyrocketing. Oh my gosh, prices are collapsing. This is the wrong thing to do. It's bad data. That's bad analysis.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.